Hello, everyone. Wow, it's been a long time since I've done one of these. Given the total panic that it feels like the market is in right now, I thought that I would make a comeback to YouTube to talk about something that have been on my mind and some questions that I've asked myself as well, which are, should we continue investing? What should we invest in now that the market is going, so down in like record levels of downs that we haven't seen since 2007, basically. Um, in such records lows that we haven't seen since the early 2000s, which was a concerning time, as we all know. Some of you probably weren't born yet, but you've all heard of the multiple market crashes of those times. And yeah, with so much noise around, I wanted to kind of like bring some clarity into what investing really is for, why do we do it, and how should we behave now that it's all going to shambles and it feels like everyone is panic selling, everyone is telling you to buy gold, to not buy Bitcoin by any means, to sell your stocks and make a profit if you can still make it, etc. So what holds true and how should you behave? So if that's interesting to you, then keep on watching. Before we do this, a quick recap on what investing really is and why you should even do it in the first place. The most simply put way of explaining investing is the way in which you get your money to work for you. It's not the only way. Of course, there is also owning assets, basically. So if you own an investment property, but then even then, this is a form of investing, right? So an investment property, the company, the value of the property hopefully increases for you. And then if you are investing it out, like renting it out to people long or short term, then you're also making a profit through that rent that comes through. So that's a type of investing. But yeah, so simply put, is a way to get your money to not stay still or lose value by the just like the sheer existence of inflation. And money that is worth now something will be worth less in time. And it's a safer ways to create wealth for yourself. It used to be completely unattainable for normal people, for the average person to be able to invest, to purchase a piece of a company, which is what investing is, and jumps through all these hoops and high fees that the stockbrokers would create, that it rendered it completely impossible for most people to do so. Nowadays, this has completely changed, and we'll go into where to invest in towards the end of this video. Before we do this though, we need to explain what the stock market is, because when you're investing most likely in the stock market because this is the most attainable and lowest entry to barrier way of investing. Very few people actually know what the stock market is. It's a term that gets thrown around a lot, and especially in news headlines and things like these, but really few people know the true functioning of the stock market. So in the most simply put way, when you're buying into the stock market, you're buying a share or a small piece of a company. So if you buy a share of Coca-Cola, you own a very tiny piece of Coca-Cola, and more often than not, hopefully that means that you believe in Coca-Cola, that believe in the product, believe in the long-standing nature of the company, what they've done, and that they will continue growing and increasing market cap. So the stock market is essentially a marketplace where people trade tiny pieces of companies, and this really goes up and down all day. It's basically people that say, one person will say, oh yes, I believe that Coca-Cola will go up, and so I'm buying more of it, and then someone else maybe loses interest or conviction in Google, let's say, and so they sell their stocks, and so everything flows and goes up and down. Maybe someone else has bought the stocks or like the shares of Google that the other person has sold, etc., etc. You get the gist. And there are typically, or well, simply put, two ways of making money from the stock market. One is, let's say you buy a stock, you hold it for some time, that can be months, or as I always recommend, years, really, so long timeline and long horizon. And later, after this time horizon has passed, the stock has gone up, so you sell it and you make a profit, which are called capital gains. This is one way in which people have been making profit most traditionally, and also the way in which day trader try to make profit, albeit on much shorter time horizons and timelines of hours, days, if not hours. The other way is through dividends, and dividends are paid out by companies on a regular basis. Some do it quarterly, some do it bi-yearly, and it's a way for the company to say thank you to the shareholders and really keep them investing and making sure that they reinvest their money into the company. I always recommend reinvesting dividends automatically, and it's just like a nice little boost to your portfolio once you get that extra few £100 or dollars into your account. So what should you invest in? And this is the $1 million question. Picking individual stocks, I would say, is an option, but it's very, very risky. If you want to do that, I always recommend, I own some stocks, right? I have a few individual stocks. I think I have 5 or 6 at this time. But they make up such a small portion of my portfolio, my overall invested funds. I think it's probably 2%, 3% at most. And even then, I've made sure to research those companies, try and understand some financial fundamentals. It's sectors that I do believe are going to shape the future of the world that we are in. So for me, it's also like a fun way to experiment in a different way of investing that I haven't done so far. But yet the best way that I still recommend for vast majority of people to invest is by not even bothering with that, which is what I've been doing for most of my investing journey. I've been investing now for almost a decade, which is crazy to think. So don't even bother with that. And you can buy all of these companies or like different compositions and cuts of companies through what are called index funds or ETFs, exchange traded funds, which are very similar one to the other. So the index fund that follows the S&P 500, for example, is a compilation of all the biggest 500 companies in the US. And so how they behave, this conglomeration of companies, how they perform, the S&P 500 index fund will perform and follow. So you reduce your risk massively, and it's the easiest and most simple way to diversify your portfolio. Now, of course, there is a lot of commentary now that the S&P 500 isn't as diversified as it was in the past, and it's absolutely true. There are a few companies at this time. I mean, I'll look into this, but at this time, I believe the top 5 or so companies in the S&P 500 make up the 80% of returns of all the S&P 500. So it's very much skewed already as an index. So you might as well buy it and already try and diversify it, then make it even more skewed by selecting just a few top companies that make up the index. And also another commentary is that the US economy itself is going through its own uncertainties right now. So if you only were to invest in the S&P 500, you would only be investing in the US basically, and you may want to do that, but I always recommend diversifying and reducing the risk also from a geographical point of view. And so that's where you may want to look into a global index fund instead. Or you may, if you're European, I have a few European only index funds. I have a few emerging markets index funds, etc. So as you can tell, diversification is the name of the game, both in terms of what you're investing in and where you're investing into. And finally, let's get to the very practical side of it. How do you actually invest? So you would pick an investment platform. For me specifically, it's mainly through Trading212. The key things for you to look into before you choose your platform is it has to be regulated and reputable. So it's been around for some years at least, and there's no scandal or no drama that the company is implied with. And also very importantly, try to find the platform with the lowest fees possible. This compounded in time has the potential to either very positively affect your investments if you have very low fees, or if they're not as low, that's where even the 0.01% change really makes a difference over a longer time period, thanks to compounding. And compounding works in 2 ways, right? It's always positive, it helps massively speed up your wealth creation journey, or on the opposite side, it can also compound and negatively detract from your money basically. Then in the UK, we have something called an ISA, which is a tax-free wrapper that your money, if you're invested through an ISA, can grow into basically. So the limit for us, it's a tax efficient account, very simply put. There's different types of ISAs. In this case, it would be a stocks and shares ISAs. In the UK, the limit is 20K per year, which is very, very high actually. I know in the US there's a Roth IRA where I believe the limit is between 7 and 8K, so significantly lower. But still, make sure that you're first maximizing and capping that out if you're able to, because of course any capital gains on that money invested are tax-free, which is amazing. In some parts of the world, maybe your work pension could even be more or as beneficiary as this tax wrappers, because your employer will likely be paying into your pension as well and matching your contributions. Of course, the caveat with that is that likely there are often, I mean, always, basically every time, age constrictions around when you can withdraw that money from, if it's invested through a pension. So, do your own calculations, understand when you may want to access those funds, and see if it's before the deadline or the minimum requirement age-wise. Then you may want to choose an account that allows you to withdraw that money beforehand. And then, the second step really after, you've made all your considerations in terms of the platform is add the money, very simply. Most platforms these days even offer you that you can open an account by investing £1 or $1. So up to you. If you already have some conviction, I would say don't delay investing any further and just go with like 100, 200, something that is significant to you. But you can open an account if that's the first step that you want to take. You can just open with £1 and that would be it. And then choose your investments, right? So we've talked about the diversification in terms of assets and geographies. So I recommend, and again, this is not financial advice, but my own portfolio is made up of a mix of globally diversified investment funds or index funds. So yeah, do your research and then start. My main recommendation and advice is start simple, don't overthink it, which is very rich coming from me. I'm a certified overthinker, but don't overthink it. Invest in the broadest index fund that you can find, globally diversified. I will link below some of the ones that I've invested in. And then you can refine and tweak and add some more, specific ones in terms of sector or geography as you do your research. But just get started. And last but not least, very important, automate it. I cannot stress this enough. Set up a monthly direct debit. And this is the best way for you to ride out and smooth out any highs and lows that the market inevitably will go through. As we're seeing now, we're in a very deep low, and we have been in the past few weeks. But through dollar cost averaging, so investing the same amount at the same time each month, you are making sure that you're riding those waves and really smoothing out the highs and lows of the market. And it also, at the same time, creates a great habit of you just investing no matter what happens, which leads me to kind of like the final point around this video, what we're at right now, which is what if the market crashes? What if it goes to an all-time low? What should I do? The answer is do nothing, if not keep investing. Honestly, we always say that when the market goes down, it's sales season. I mean, it's Black Friday now, right? Or like roundabout. So it's a time where you can buy more, theoretically. The more savvy investors actually have saved up some money, some unallocated funds to exactly for the market dips. And there are some investors that really make the most of these unallocated funds and really buy up the market because they know that inevitably it will go up in time if you have a long enough time horizon and you give it time, basically. So yeah, if you're very well diversified, if you're invested in multiple different globally diversified funds, then your portfolio will live through some differences, but it will also survive them. And often what happens is the biggest risks to investors is not the market, really, like what happens to the markets and the volatility, but it's themselves. It's the people that get thrown into these frenzies of panic selling. And, like they read the headlines are like, oh my God, we're doomed. Let me cash it all out. Let me buy gold and go live in a mountain. I don't know. And maybe it turns out that the person that was making that commentary was completely wrong and the market actually goes up, the next day. And so the person, in the best case scenario, this person sold for a profit still, they've still made money. And so it's not that bad. But in the worst case scenarios, they've sold at a loss. So they didn't make a profit, they make the loss. And when they want to re-enter the market, they are buying something that was more expensive than what they bought it for. So automating really stops you from panic selling, which is the worst enemy of any investor. And I really recommend you read into behavioral economics, for example, that really studies all the influxes and the highs and lows of investing, and how psychology plays a part into investing for most investors. But that was it from me. So I guess the takeaway is just keep investing, just keep doing your thing, don't get thrown into a panic by the headlines. It's a very turbulent time, so I'm not saying I don't understand that what people are going through, but the best way to weather the storm, as they say, is to continue doing what you're doing, diversifying, and being patient, really. And so with that, I will see you next video, and I'll be more consistent this time. I'm back. I really missed speaking to a camera. Okay, goodbye.